If you haven't heard about the real estate crash, don't worry. If you have no idea about it and want to know, then stick till the end to this video because here, the bizarre 2023 crash is going to be explained in detail. The housing market crash becomes more and more obvious with each passing day. Following a record-breaking 11-year rally that ended in the summer, the market is finally showing signs of complete collapse, but this data isn't being shown to the mainstream chart. Specifically, the commonly referenced Case-Shiller Index only exhibits a downfall of 2.7%, with most other outlets reporting prices remaining relatively stable. It's causing many to become blind to what is happening on the ground right now, ignoring strong evidence pointing to a serious downfall, a downfall that stems from the investment side of the market sector, with stats so bad, many experts are predicting that this crash will be worse than in 2008. To understand the surprise real estate crash, which is catching everyone off guard, we first need to take a step back and understand some of the histories that explain the underreported relationship between real estate investing and home prices. During the last major housing crash in 2008, the first people to feel the downturn's effects were residential investors. Normal people only felt the effects after investors were forced out. As home prices crashed 26% on a national level, most people accepted the root of the problem as subprime loans given the way to people who couldn't afford them, aka poor people were given way too much money to buy houses they couldn't afford, and while that story was partially true, it's not what many experts believe to be the actual cause of the crash. According to various papers, including this one by the National Bureau of Economic Research, it was greedy investors who propped up the market in '08, causing it to implode. The reason I'm telling you this, because if you understand this bit of history, you'll see that it's repeating itself differently today. Today, we found new members of the Case-Shiller, which showed national home values down 2.4% from their peak in the summer. Now, while that may not sound huge, it's the second worst decline since World War II. The latest update means that for 4 months in a row, values have declined throughout the United States, and before these dips, Case-Shiller hadn't reported a month-over-month home value decline since early 2012. The nominal home price dips are extremely rare at the national level, and what's happening right now is indicative of a larger problem that will continue in 2023. Specifically, the problems right now are concentrated on the investment side, which doesn't get a lot of attention, and the same thing happened back in '08. According to the investment first theory, the argument is simple. It was wealthy or middle-class home flipping speculators, not the poor people, who blew up the bubble to cataclysmic proportions and then wrecked local housing markets when they defaulted en masse. The evidence behind this can be found in the credit report, analyzing a huge dataset of anonymous credit scores from Equifax. Various economists found that during the housing boom, the greatest growth of mortgage debt came from those with credit scores in the middle and top of the credit score distribution, and these borrowers accounted for a disproportionate share of defaults. Essentially, this says that investors led the way in the last crash, and as you're about to see, the same thing is happening right now. According to a CNBC report, gross flipping profits were down 18.4% from the second quarter and down 11.4% year over year. It represents the smallest profit since the end of 2019 and the fastest quarterly drop since 2009. One could argue that the home flipping market is completely dead. One thing that differs from this crash in 2008 is the fact that we have a new kind of home flipper, iBuyers, which are massive prop tech companies that engage in home flipping on a mass scale. The largest of these iBuyers, called Opendoor, is down 94% from its peak price back in February of 2021. Many people claim that Opendoor is on the brink of bankruptcy, and with more than 10,000 homes on its books, wonder about the true state of this market given these downfalls. The company, which has survived 8 years of business and is now under serious threat, now you should think about all the others in the space as well. Zillow is the first, followed by Redfin, and most iBuyers have shut down or suspended operations. There are plenty of other smaller and private operations that are likely experiencing the same issues and slowing down as well. Redfin does a very good job capturing this truth with its quarterly investment report. The one released in late November proves that investors are bailing at a record pace. The year-over-year change in the number of U.S. homes bought by investors is approaching 2008 levels, and the reasons behind this are pretty simple to understand. Residential real estate flipping margins are wide in the lead up to this year. We had extremely low interest rates, record high appreciation, and a consumer that was willing to pay a heavy premium for move-in ready homes. Each of these variables has come under pressure as prices are moving down at a record pace, which means investors who often take months to purchase, fix, and sell properties are now battling time, with each ticking second depreciation increasing risk, eating away their profits, and causing serious losses. On top of this, interest rates have moved up to 7%. So anyone using loans to fund their business has much heavier costs associated with holding any amount of inventory, and then finally we have a consumer whose entire psychology has been reversed. According to the University of Michigan, the overwhelming majority of people now believe it's a very bad time to buy a home. Please take a minute to hit the like and subscribe button if you're enjoying the video so far. The University of Michigan survey stretches back to the 1960s, and today, we're seeing record low numbers that are competing with all-time lows. As long as this market psychology remains intact, consumers will begin to fuel a self-feeding loop. It becomes beneficial to wait until you know something is going to get cheaper and cheaper month after month. Price drops increase exponentially due to the deflationary loop as more and more consumers realize this. Regardless of these factors, we have the most important development leading to the demise of the market, and that's the increase in the risk-free rate. Now that may sound a bit boring, but ultimately, at the center of this issue, there's one simple problem that can't be ignored. We know from real estate investors that a good return on the property is anywhere between 7 to 15%. Of course, there are a lot of variables that can influence this number, including things like leverage returns by either buying deals and renting them out, long-term profiting from appreciation and rental income, or buying fixer-uppers and reselling them for profits called flipping. So how is all of this connected to the risk-free rate and the worst housing crash since 2008? Well, it's a simple explanation. Like I just stated, the flipping business has become extremely difficult to operate. Most flippers know that the way you make money is on the initial purchase. Finding good deals is bread and butter, but it's becoming increasingly hard to find these deals with home sales and inventory tight. Above all, we have higher rates and falling prices along with the change in consumer psychology. This is the reason mass flippers have been failing down 98% over the past year and a half. While data on private flippers is hard to get, we could assume that they're experiencing some of the same problems that these iBuyers are facing. There's only one other major way to make money in residential real estate, as the flipping is facing a crisis, and that is passive rental income. But nothing's wonderful on that side too. Rental demand is falling off a cliff, and real estate investing profits are gaining competition from the risk-free rate. Currently, the 2-year Treasury yield is 4.3%, which means that you can easily park your money in a bank account, and without ever lifting a finger, you can make pretty good profits. If we compare that to the 7 to 12% you'll get from real estate investing, you'll see now we have a problem. We know that the passive income from housing isn't without risk, and you're exposed to all kinds of problems, including damage, falling home prices, bad tenants, unfavorable landlord laws, and plenty of other things that we won't even mention. The higher your risk rate increases, the lower the number of investments that will pour into the residential real estate space. Because when you get similar returns from guaranteed fixed income, then why go through the trouble of taking on significant risk and effort? Americans have enjoyed extremely low interest rates for the past 15 years, which has led debt to become rewarded in savings punishment. The 2-year yield hasn't risen above 4% since 2008. So there's been an entire decade where real estate returns have been very lucrative for investors who plowed borrowed money into real estate, buying up properties for little to no cost on the interest end. This is now changing for the first time in a long time, and it's going to have profound facts acting as gravity on the entire sector, pushing down investment and prices. We'll likely continue to see Case-Shiller plummet in 2023 as the housing crash ramps up and values are normalized across the nation. Let me know down below if you plan on buying an investment property this year, and as always, thank you so much for watching. please don't forget to hit that like and subscribe button if you enjoyed this video.